A good day, everyone. Today we are going to report on corporate governance mechanisms, specifically about auditors, creditors, and rating agencies. Presented by Group 3 with the members Dumaluan, Espinosa, Fondavilla, Gallardo, and Go. The points of discussion are the definition of an auditor, creditor, and rating agency, their specific roles and responsibilities, and their importance towards an organization. So, number one, what is an auditor? An auditor is a person who is authorized to review and verify the accuracy of financial records and ensure that companies comply with tax laws. They also protect businesses from fraud, point out discrepancies in accounting methods, and on occasion work on a consultancy basis, helping organizations to spot ways to boost operational efficiency. Furthermore, auditors work in various capacities within different industries. Understanding an auditor. So, as mentioned, auditors assess financial operations and ensure that organizations are run efficiently. They are tasked with tracking cash flow from beginning to end and verifying that an organization's funds are properly accounted for. In the case of public companies, the main duty of an auditor is to determine whether financial statements follow generally accepted accounting principles, or the GAAP. To meet this requirement, auditors inspect accounting data, financial records, and operational aspects of a business and take detailed notes on each step of the process, known as an audit trail. Once complete, the auditor's findings are presented in a report that appears as a preface in financial statements. Separate private reports may also be issued to company management and regulatory authorities as well. So here are the types of auditors. First are the internal auditors. They are hired by organizations to provide in-house, independent, and objective evaluations of financial and operational business activities, including corporate governance. They report their findings, including tips on how to better run the business, back to senior management. Second, we have external auditors. They usually work in conjunction with government agencies. They are tasked with providing an objective public opinion concerning the organization's financial statements and whether they fairly and accurately represent the organization's financial position. Third are the government auditors. They maintain and examine records of government agencies and of private businesses or individuals performing activities subject to government regulations or taxation. Auditors employed through the government ensure revenues are received and spent according to laws and regulations. They detect embezzlement and fraud, analyze agency accounting controls, and evaluate risk management. Lastly, we have forensic auditors. They specialize in crime and are used by law enforcement organizations.
For the next part, we will be discussing the roles and responsibilities of auditors. Firstly, auditors have the role of preparing an audit report. So, an audit report, in simple terms, is an appraisal of a business financial position. The auditor is responsible for preparing an audit report based on the financial statements of the company. The books of accounts so examined by an auditor should be maintained in accordance to the relevant laws. In addition, it is important that an auditor ensures that the entity's financial statements depict a true and fair view of the company's financial position. Next, an auditor forms a negative opinion where necessary. The auditor's report has a high degree of assurance and reliability because it contains the auditor's opinion on the financial statements. Where the auditor feels that the statements do not depict a true and fair view of the financial position of the business, they are also entitled to form an adverse opinion on the same. Additionally, where an auditor finds that they are dissatisfied with the information provided and finds that they cannot express a proper opinion on the statements, they will issue a disclaimer of opinion. A disclaimer of opinion basically indicates that due to the lack of information available, the financial status of the entity cannot be determined. However, it is to be noted that the reasons for such negative opinion are also to be specified in the report. An auditor also makes inquiries. One of the auditor's important duties is to make inquiries, as and when they find it necessary. A few of the inquiries include whether loans and advances made on the basis of security are properly secured and the terms relating to the same are fair, whether any personal expenses or expenses not associated with the business are charged to the revenue account, where loans and advances are made, and whether the financial statements comply with the relevant accounting standards. Moving on, auditors lend assistance in case of a branch audit. When the auditor is the branch auditor and not the auditor of the company, they will lend assistance in the completion of the branch audit. They shall prepare a report based on the accounts of the branch as examined by them and then send it across to the company auditor. The company auditor will then incorporate this report into the main audit report of the company. In addition to this, on request, if they wish to, they may provide excerpts of their working papers to the company auditor to aid in the audit. Next, an auditor complies with auditing standards. It is the duty of the auditor to comply with the standards while performing their duties, as this increases their efficiency comparatively. An auditor also reports frauds. Generally, in the course of performing their duties, the auditor may have a certain suspicion with regard to fraud that's taking place within the company. Certain situations where the financial statements and the figures contained therein don't quite add up. When they find themselves to be in such situations, they will have to report the matter. Next, the auditor must adhere to the Code of Ethics and Code of Professional Conduct. The auditor, being a professional, must adhere to the Code of Ethics and the Code of Professional Conduct. Part of this involves confidentiality and due care in the performance of their duties. Another important requisite is professional skepticism. In simple words, the auditor must have a questioning mind, must be alert to possible mishaps, errors, and frauds in the financial statements. And lastly, auditors have the responsibility to offer assistance in an investigation. In the case where the company is under the scope of an investigation, it is the duty of the auditor to provide assistance to the officers as required for the same. Hence, it can be seen that the duties of the auditor are pretty diverse. It has an all around and far reaching impact. The level of assurance provided by a set of audited financial statements is comparatively far higher as compared to regular unaudited financial statements. Moving forward, we have the importance of auditors in corporate governance. An auditor represents the interests of shareholders. One of the primary roles of external auditors in corporate governance is protecting the interests of shareholders. This is possible because external audition reports are conducted independent of the company's influence. External auditors report the state of a company's finance and attest to the validity of financial reports that may have been released. They ensure that the board receives accurate and reliable information. The board may also question the auditor's views and assessment on the appropriateness of the accounting principles used by a company. Next, auditors also promote accountability. External auditors may introduce measures and policies designed to compel accountability in the workplace. For instance, auditors could recommend penalties for officers who manipulate financial statements by inflating figures or cooking accounting numbers. Penalties for such acts could include stripping the manager of his position or his compensation, such as reducing annual bonuses and even pensions. Next is crisis management. External auditors can help ensure good corporate governance by developing efficient crisis management plans to be used in the event of allegations of fraud or corruption. The plan typically involves assigning responsibilities to different administrative officials. This way, if the company becomes involved in a financial crisis, officials have an active plan that they can use in sustaining confidence among investors. Crisis management plans may also include control measures that are to be used with the media and law enforcement officials.
Next, we have the creditors. So, what is a creditors? A creditor is an entity, maybe a person or institution, that extends credit by giving another entity permission to borrow money intended to be repaid in the future. It doesn't have to be cash. A loan can comprise anything that has perceived or practical value. For example, stocks or equipment. A business that provides supplies or services to a company or individual and does not demand payment immediately is also considered a creditor, based on the fact that the client owes the business money for services already rendered. Creditors can be classified as either personal or real. People who loan money to friends or family are personal creditors. Real creditors such as banks or finance companies have legal contract with the borrowers. sometimes granting the lender the right to claim any of the debtor's real asset like real estate or cars if they fail to pay back the loan. So understanding a creditor. So to put it simply, creditors make money by charging interest on the loans they offer their clients. For example, if a creditor lends a borrower 10,000 pesos with a 5% interest rate, the lender makes money due to the interest on that loan. Consequently, the creditor accepts a degree of risk that the borrower may not repay the loan. In order to mitigate risk, most creditors index their interest rate or fees to the borrower's creditworthiness and past credit history. Thus, being a responsible borrower could save you a substantial sum, particularly if you're taking out a large loan like a mortgage. Interest rate for mortgage vary based on a myriad of factors, including the size of the down payment and the lender itself. However, once creditworthiness has a primary impact on the interest rate, borrowers with great credit scores are considered low risk to creditors, and as a result, these borrowers garner low interest rates. In contrast, borrowers with low credit scores are riskier for creditors, and creditors charge them higher interest rate to address the risk. Which is why being a responsible borrower could save you a substantial sum, as mentioned a while back. What happens if creditors are not repaid? So if a creditor does not receive repayment, they have a few different options. Personal creditors who cannot recover a debt may be able to claim it as a short-term capital gains loss on their income tax return. But to do so, they must make a significant effort to reclaim the debt. Creditors, such as a bank, can repossess collateral such as homes and cars on secured loans, and they can take debtors to court over unsecured debt. The courts may order the debtors to pay, garnish wage, or take other actions. Moving on to the roles and responsibilities of creditors. As providers of risk capital, both creditors and shareholders are exposed to the residual risk of companies they invest in, and debt tends to be a permanent form of capital in most companies, even if individual debt issues are serviced and then reissued. Sustainable and health companies should seek to maintain positive relations with both creditors and shareholders to ensure cost effective access to both debt and equity capital. In turn, boards should ensure that company governance and capital allocation mechanisms reflect a fair and appropriate balancing of shareholders and creditor interests.
So the next one is how creditors affect corporate governance. So in 1997, they argued that corporate governance deals with the ways in which the supplier and finance to corporation assure themselves of getting a return of investment. Then creditors possess both the ability and incentive to advise and monitor the firms in their portfolios. So creditors exert more influence when they retain more of the loan, decreases in cash, activity shareholders payout, and salary expenses are more pronounced when creditors hold more concentrated position. Greater creditor control over governance is associated with increasing investment in inventories, capital expenditure, and property, plant, and equipment. Firm profitability and cash flow from operation are higher when creditor positions are more concentrated. Creditor governance after a violation is a strong determinant of changes in firm policy and performance. The presence of a large institutional stakeholder, whether creditor or shareholder, is a strong determinant of changes in firm policy and performance. In other words, though previously thought be silent provider of capital at least until a borrower is in trouble, creditors like institutional shareholders serve as valuable and important role in corporate governance. So next we have the creditors' expectation of companies. So the conflict between shareholders and creditors will never be completely eliminated even for companies in a healthy financial position. But there are fundamentals government's expectation that creditors can express that need to conflict the interests of equity investor. These include statement of financial policy and capital allocation. This should cover a company's own statement of use of debt, financial leverage, and address its overall approach to capital allocation. A risky financial strategy is not flawed as long as it is appropriately communicated to creditors. So the next one is the risk management, including ESG risk. The third one is the board effectiveness. Shareholders and creditors want strong board to provide independent support and constructive challenges to company and its executive management. As part of the governance of sustainability, creditors expect board to demonstrate appropriate understanding and oversight of ESG risk. So the fourth one is audit, accounting, and reporting. Creditors have a clear interest in robust audit process and prudent accounting policy to ensure accurate reporting and guard against financial risks. Creditors should encourage integrated reporting to ensure consideration of so-called non-financial or pre-financial issue. So the last one is remuneration. Incentive structure should discourage executive management to take risks to receive bonus award. This is relevant to all corporate issue but of particular relevance to financial institutional given their high gearing and systematic significance. So, as of the importance of creditors, a sustainable company should seek to satisfy the legitimate needs of its creditors since they play a critical role in financing long-term growth and sustainable value creation. Investors should build sensitivity towards reconciling the difference between legitimate perspective of corporate creditors and seek identify common areas of alignment as an aspect of stewardship and engagement. Taking a long-term view, a constructive tension between protecting creditors' interests while generating fair returns for shareholders can hopefully steer companies from the extreme of unwarranted financial risk or conservatism to enable a company to achieve its overall mission, including satisfying the requirements of all its financial stakeholders as a matter of stewardship and engagement. Creditors should inspire to find common ground to engage with the companies to adopt business models, corporate strategies, and financial policies that are positioned to stand the test of time.
And lastly, we have rating agencies. A rating agency is a company that assesses the financial strength of companies and government entities, especially their ability to meet principal and interest payment on their debts. The rating assigned to a given debt shows an agency's level of confidence. The borrower will honor its debt obligations as agreed. Each agency uses unique letter based scores to indicate if a debt has a low or high default risk and financial stability of its issuer. The debt issuer may be sovereign nations, local and state governments, special purpose institutions, companies, or nonprofit organizations. Next are the roles and responsibilities of rating agencies. Rating agencies assesses the credit risk of specific debt securities and borrowing entities. In the bond market, a rating agency provides an independent evaluation of the creditworthiness of debt securities issued by governments and corporations. The ratings are used in structured finance transactions such as asset backed securities, mortgage backed securities, and collateralized debt obligations. Rating agencies focus on the type of pool underlying the security and propose capital structure to rate structured financial products. The issuers of the structured products pay rating agencies to not only rate them, but also to advise them on how to structure the tranches. Rating agencies also give ratings to sovereign borrowers who are the largest borrowers in most financial markets. Sovereign borrowers include national governments, state governments, municipalities, and other sovereign supported institutions. The sovereign ratings are given by a rating agency which shows a sovereign's ability to repay its debt. The ratings help governments from emerging and developing countries issue bonds to domestic and international investors. Governments sell bonds to obtain financing from other governments and Bretton Woods institutions such as the World Bank and the International Monetary Fund. As for the importance of rating agencies in corporate governance, they provide an advantage to investors as credit rating provides objective, independent, and reliable opinion on credit quality, which facilitates an informed investment decision. It gives superior information about the rated product and to a low cost, which the investor otherwise would not be able to procure so easily. Thus, the investor can easily recognize the risk involved and expected advantage in the instrument by looking at the symbols. Next is marketability of securities. Issuers seek ratings for a number of reasons, including to improve the marketability or pricing of their financial obligations, to improve the trust of their business counterparties, or because they wish to sell securities to investors with preferences over ratings. Lastly, rating agencies provide benefits for the issuer as credit rating enhances the ability of the borrower issuer to access the money and capital markets for tapping larger volumes of resources from a wider range of investment options. It helps in procuring funds at a better interest rate and helps establish creditability among investors. Credit ratings also help in imposing health discipline on corporate borrowers and encourage financial discipline. And finally, just to give a short summary of the discussion, we identify an auditor as a person who is authorized to review and verify the accuracy of financial records and ensure that companies comply with their tax laws. Moreover, there are several, including those hired to work in house for companies and those who work for an outside audit firm. And final judgment of an audit report can be either qualified or unqualified. A creditor is an entity, may it be a person or an institution, that extends credit by giving another entity permission to borrow money intended to be repaid in the future, and it does not have to be cash. A loan can comprise anything that has perceived or practical value, for example, stocks or equipment. Furthermore, creditors such as banks can repossess collateral like homes and cars, unsecured loans, and they can take debtors to court over unsecured debts. And lastly, a rating agency is a company that assesses the financial strength of companies and government entities, especially their ability to, to meet principal and interest payments on their debts. And that concludes our discussion. Thank you.